In the last 3 years, more than 220 companies that were once worth over $1 billion quietly stopped being worth $1 billion. And here is the strange part, almost none of them did anything wrong. They didn't lose customers. They didn't run out of cash overnight. They didn't get caught in a scandal. Their revenue, in many cases, kept growing. Their only real crime was timing. They raised money before a single product launched in late 2022, and that one event slowly turned them from the future into the past. PitchBook calls them fallen unicorns, and the list reads like a who's who of brands you actually use. So what happened? How does a healthy, growing company lose its billion-dollar status without making a single obvious mistake? The answer is one of the fastest reallocations of money in business history, and by the end of this you'll understand exactly why it happened, who got hit hardest, and what it means if you're building anything right now. Let's rewind. For most of the last decade, the dream was simple. You start a company, you grow fast, and if you can convince investors you're worth $1 billion, you become a unicorn. That word used to mean you had made it. It meant prestige, talent flowing to your door, and an almost unlimited line of credit from venture capitalists who believed the line only went up. And for a long time, the game rewarded a very specific kind of company, software businesses growing maybe 40% a year, signing enterprise contracts, hiring hundreds of engineers to build features one at a time. That was considered excellent. Investors would happily write follow-on checks to keep those companies alive and growing. The whole system was built on a quiet assumption that this pace, this model, this way of building, was the ceiling of what was possible. Nobody questioned it because nobody had a reason to. Until somebody handed the entire world a tool that made 40% growth look slow, and made 500 engineers look like a rounding error. Here's the scale of it. According to PitchBook's valuation estimates, more than 220 companies that once carried billion-dollar price tags have now slipped below that threshold. And these aren't obscure names. The cohort includes consumer brands you'd recognize instantly, names like Glossier, Savage X Fenty, AG1, and The Farmer's Dog. Companies with real products, real revenue, and real customers. The numbers behind the collapse are brutal. Startups that last raised money in 2021 are now worth, on average, 68% less than their peak. The ones that last raised in 2022 have fallen by roughly 52%. Think about what that means. Half your company's value, or more, erased, not because the business broke, but because the world around it changed and you didn't get a chance to reset the clock. These are estimates, not fire sales, but they reflect what the market now believes these companies are actually worth. And the reason for that belief comes down to a single moment. That moment was late November 2022, when ChatGPT went public and roughly 100 million people discovered, almost overnight, that you could build software by typing in plain English. Samir Kaul, a partner at the venture firm Khosla Ventures, described it perfectly. He said that was the moment people realized the next generation of entrepreneurs would code in spoken English, and that you're now seeing 50 engineers do what it used to take 500 engineers to do 5 years ago. Sit with that for a second. A 10-to-1 collapse in the people, the time, and the money required to build. If you're an investor staring at two companies, one a traditional software business growing at 40% a year, the other an AI-native startup growing at 200% with a tenth of the headcount, where does your next dollar go? It's not even a close call. And that single shift in where money flows is what quietly drained the value out of an entire generation of companies that had done nothing but exist at the wrong time. Now, you might expect the pain to be spread evenly, but it isn't. The sharpest damage landed in one specific place, enterprise software. On PitchBook's fallen unicorn list, around 75 of the companies are SaaS businesses. That's double the next largest category, fintech. And the irony is almost cruel, because enterprise software was the golden child of the last decade. These were the safe bets, the predictable revenue machines, the companies you funded because they almost couldn't fail. But predictable, recurring revenue is exactly what AI threatens most directly. If a customer can spin up an internal tool in an afternoon with an AI agent, why would they keep paying a 5-figure annual subscription for software that does roughly the same thing? That question is now being asked in boardrooms everywhere, and the market has already priced in the answer. The companies that looked safest turned out to be the most exposed, because the thing that made them valuable, locked-in software, is the exact thing AI is best at unlocking. But money doesn't disappear, it moves. And while 200 companies were quietly falling, the capital that left them was pouring into AI at a pace that's hard to even describe. In the first quarter of 2026, AI companies captured around 81% of all global venture funding. Read that again. 4 out of every $5 committed by venture capitalists went to AI before a non-AI founder even got into the room. The concentration is so extreme that if you remove just the 5 largest deals, total deal value would drop by more than 70%. This is what a reallocation looks like in real time. The same investors who once funded steady 40% growers are now chasing companies expanding 200% a year with tiny teams. It's the largest, fastest shift of capital toward a single technology that most people in the industry have ever witnessed. And it explains the whole picture. The fallen unicorns didn't lose their money. They watched it walk across the street to a newer, faster building. So here's the lesson, and it matters whether you want to start a company or just keep your career safe in an AI-first economy. The fallen unicorns weren't punished for being bad. They were punished for being built for a world that no longer exists. Their cost structures, their team sizes, their pace of building, all of it was calibrated to a reality that ChatGPT quietly deleted. And that's the real warning here. In a moment like this, standing still is the same as moving backward, because the ground itself is shifting under everyone. The companies winning right now aren't necessarily smarter or better funded. They're just built natively for the new economics, where small teams move fast and English is a programming language. You don't need to raise $1 billion to apply that lesson. You need to ask yourself one honest question: are you building for the world as it is today, or for the world as it was 3 years ago? Because the gap between those two worlds is exactly where 220 companies just fell. The thing I keep coming back to is how quiet it all was. There was no crash, no headline screaming collapse, no single dramatic day. Just a slow, steady drain of value from companies that, by every old measure, were doing fine. That's what makes this moment so different from past bubbles. It isn't destroying bad businesses. It's quietly retiring good ones that were built for yesterday. And the same force that erased $200 billion valuations is the one minting brand new ones at record speed. The question isn't whether the shift is real, it clearly is. The question is which side of it you choose to build on. If you want to keep tracking exactly how this AI economy is reshaping who wins and who quietly disappears, with the real numbers and none of the hype, subscribe and stick around, because the next chapter of this story is being written faster than any of us expected. I'll see you in the next one.